and welcome to Countdown to Budget. In just a couple of weeks, the Finance Minister will be presenting the Union Budget, a budget which is expected to be big on fiscal reforms. What does it mean for the government and for you, the investor? The government believes this will help to shore up investor sentiment, prop up growth, increase revenues and strengthen finances. As my colleague Kumardeep Banerjee reports, the Finance Minister is also expected to unveil crucial revenue-generating measures.
Finance Minister Pranab Mukherjee is desperately trying to pump up the investor mood ahead of the annual policy document, the Union Budget 2012-2013. After all, if the government has to reduce fiscal deficit and strengthen its finances in the next fiscal, sending out the right signals will matter. So if the government can send out a message that it's serious about reforms and about putting its fiscal house in order, it's hoping that investors would come rushing back in, propping up growth and giving the government much needed revenues in the bargain.
The government has now put in place a new manufacturing policy to give a big push to the manufacturing sector with the objective of increasing its contribution to the GDP to 25% and create 100 million jobs in the next 10 years.
The direct tax code may only come into force from April 2013, but there are chances that a revenue-starved government, fresh from a setback in the landmark Vodafone tax case, could adopt some provisions of the DTC. So what are these provisions? General Anti-Avoidance Rule, which will allow tax authorities to investigate tax avoidance treaties. Advanced pricing agreements, which will provide better clarity to taxpayers and tax authorities over the tax impact of future transactions. Indirect transfers, providing for taxes if the asset holding threshold is met. And though there may be some tweaks in existing income slabs to shield the common man burdened by rising prices, it is unlikely that the government can indulge in big tax giveaways at a time when the finances are weak. Ushering in the landmark goods and services tax could have helped shore up the revenues, but it has been stalled thanks to political problems. What could be done on indirect taxes? The government can move in the direction. It can raise excise rates to pre-crisis levels of 12%, bring in a negative list of services, barring which all services will be taxed, raise duty on gold, which would also help slash the current account deficit, rationalize customs duty and address inverted duty structure in some industries. Clearly, the thought within the Finance Ministry is likely to keep tax rates moderate while increasing the base.
Definitely need to look at, service tax and implications of service tax to see if the net can be widened. I think this is one very big issue. I think GST in itself, while simplifying the taxation structure to a very large extent, will also result in superior collections across the various points of taxation.
That leaves the Finance Minister with looking at disinvestment and sale of natural resources for windfall revenues. While ONGC disinvestment may happen this fiscal, BHEL and a whole host of companies like NBCC could follow the same route only next fiscal. Sale of precious spectrum both in 2G and BWA could, with a positive policy framework, garner more than $2 billion. Opening up sectors like retail will get more investments. While increasing the tax rates and perhaps increasing the tax base could get more revenues for the government, Finance Minister Pranab Mukherjee should also look at the issue of subsidies, the way the subsidies are meted and it goes to the people to whom it is intended. We are talking about subsidy leakages. While it could mean a bit more money put in the information technology, that could also mean more jobs for the IT sector. Also, Finance Minister Pranab Mukherjee has to look at the way the government doles away expenditure and subsidies and ensure that he walks that tightrope between a populist budget and an economic one. Kumardeep, Bloomberg UTV, New Delhi.
One of the biggest economic policy failings of the government this fiscal has been fiscal mismanagement. With a growth slowdown staring it in the face, it failed to rein in populist expenditure even as revenues were not forthcoming. But now Bloomberg UTV has learnt that the Finance Minister is all set to alter the fiscal picture and bolster government finances. Abhijit Neogi with this special report.
It's not just the Eurozone politicians who are worried about their sovereign debt woes. Back home in India, Finance Minister Pranab Mukherjee is also losing sleep over the worsening position of the government's finances. In a year when markets tanked, inflation peaked and growth slowed, the fiscal situation has got from bad to worse. The government had budgeted the fiscal deficit target for the current fiscal at 4.6%, but will probably end the year a full percentage point more than the budgeted number. The problem has been compounded by less than budgeted revenues because of slow growth, which slipped below 7% for the first time in 2 years in the July-September quarter. Tax giveaways to the tune of 24,000 crore rupees in the petroleum sector and poor proceeds on government stake sales due to depressed market conditions have accentuated the deterioration in government finances. As a result, the government has been compelled to borrow about 22% extra money from the markets, taking its total market borrowing to 5.1 trillion rupees this fiscal, crowding out much-needed private investment demand and pushing up yields in the bond markets. Sources in the government have told Bloomberg UTV that the Economist Prime Minister Dr. Manmohan Singh and his Finance Minister Pranab Mukherjee are very clear that they do not want to leave behind a legacy of bloated public debt. In fact, the government badly wants to restore some semblance of fiscal order and may peg the fiscal deficit target for the next fiscal year at around the 5% level.
I would say that's more of a wishful thinking. I mean, that may be the target that they would like to have. My personal feeling is that they cannot really come down to 5% given the current situation.
But the big question is, will the Finance Minister unveil a roadmap to fiscal reform? The boss of India's central bank, Doveri Subbarao, certainly recommends one.
I'm hoping that we could get to see a roadmap, the way we are seeing it across various other issues. For example, in the case of coal and power, right? We will also see in terms of government expenditure across departments.
But a credible roadmap is easier said than done. For one, the Finance Minister has to balance cold economic logic with the populist instincts of the Congress top brass, especially as UPA 2 enters the last leg of its rule that will culminate into the political battle of 2014. That means trimming subsidies or doing away with some populist giveaways are practices that are not going to go away in a hurry. But the Finance Minister is left with no choice but to tighten the fisc. So he expects NVAT rates to be restored to pre-crisis levels of 12% and a negative list of services, barring which all services will be taxed. Though this may raise prices, the low inflation trajectory will help the government in taking this step. And the government has to be more aggressive on selling stakes in public sector units. Sources in the Finance Ministry say the Finance Minister's biggest bet for raking in revenues is growth, and for that, the government is likely to use the budget as a platform to signal to both domestic and foreign investors that India means business and reforms will continue. Reforms in the Indian stock markets will be in focus as the government tries to perk up sentiment and offload PSU stakes at attractive valuations. The government has to restore its fiscal house to order. That is no longer a policy option, but it's a policy imperative. And the budget will help the government go some distance in revving up those crucial revenues needed to bridge the fiscal gap. But if it indeed is serious about fiscal reform, then perhaps the government should heed what the RBI Governor, Dr. Subbarao, said the other day. Unveil a credible roadmap for fiscal reform and consolidation. Perhaps trimming subsidies and curbing wasteful expenditure is the right way to go about it. But with the political battle for 2014 already seemingly underway, that is going to be a daunting challenge both for Prime Minister Dr. Singh as well as Finance Minister Pranab Mukherjee. With cameraman Hari Kumar in New Delhi, Abhijit Niyogi for Bloomberg UTV.
Coming up, so what can you, the taxpayer, expect from the budget? What impact will it have on investments and taxes? Find out after the break. As we count down to the budget, the expectations from the different stakeholders continue to mount, as investors and industrialists hope for a boost in investments and growth from the government. The government knows that the budget is an opportunity that it wants to grab with both hands to convey that bringing India's growth back on track is its key focus and that it will usher in the next stage of reforms as priority. Ragini Verma has more.
The months of slowly fading winters are starkly contrasted with this heightened activity here at the epicenter of policy making ahead of the budget announcement. And it is on the first floor of this British-era redstone building that UPA2's troubleshooter is working overnight to draft a budget that could give the government's image a makeover. Rana Mukherjee's task is a tough one, but whispers have it that reform is in the air. While the larger theme of Budget 2012-13 for the government will be to lay down a roadmap for fiscal consolidation, even as it weighs options to increase revenues and make sectoral allocations, that alone will not be enough.
7% growth is bad.
The ghosts of last year's failings will have to be fought, and the budget, an opportunity that the government simply cannot afford to miss. The government knows it has to prop up growth to get revenues going, and one sure way to do that is to use the budget to set the tone for a pro-growth stance by signalling political intent to take the next stage of reforms ahead. And efforts to do just that have got the finance minister's team busy. There is a long laundry list of reform initiatives that have been languishing in the policy back burner for quite some time now, but top of this agenda is to push the financial sector reforms that have just not taken off. The Pension Fund Regulatory and Development Authority or PFRDA bill that is aimed at encouraging private and foreign investment in the pension sector, the Insurance Law Amendment Bill that proposes 49% FDI in insurance, the Banking Laws Amendment Bill that proposes to align the voting rights in line with the shareholding pattern in banks are some key bills to name a few. The government will also do well to push other key economic legislations like the Companies Bill that seeks to modernize the corporate law structure by replacing the archaic Companies Act 1956 to signal seriousness in improving the investment climate.
This is the last opportunity for the current government to show this kind of seriousness and show that you need to pay for the second wave of reforms, because the next budget is going to be almost like an election budget.
But the one initiative that has almost become synonymous with the government's appetite for reforms is the move to permit 51% FDI in multi-brand retail, a promise made by no less than the Prime Minister himself. But one that became a non-starter thanks to what is now famously blamed on coalition compulsions. But sources in the know have told Bloomberg UTV that the government may again move on the issue after the state elections and the budget process get over in mid-March. In fact, Prime Minister Manmohan Singh, in an interview to Bloomberg said, and I quote, "We wanted to open retail but had to put it on hold. I think there was inadequate preparation and some partners in the coalition developed cold feet. But I can assure you, India remains committed to a system of regulation that is supportive of enterprise, and we will do everything to encourage foreign investment." The success of these proposals hinges closely on the government's success at arriving in the mantra to work around the compulsions of coalition politics, the single most important key for UPA2. And the outcome of state elections conducted in 5 states will set the stage rolling for how many of these signals translate into actual reform measures on the ground. A reason why the government will also include nuts and bolts reforms, which though not big ticket, will bring about positive results, and may leave out reforms like diesel deregulation for now for the fear of political backlash.
You have to remember that there are two sides of policy making. One is the big ticket reforms. We want to get that back. A lot of it has not happened. I hope that that will happen. But another thing which catches very little attention, on which actually the last budget did a lot, is nuts and bolts reform. Very often when the biggest reforms get stuck, you begin to work on the nuts and bolts of the economy.
The budget's significance will lie in how the government uses it to make up for the disappointments that policy flip-flops and inaction have caused, and use it to send the right message to the investor community and corporates that India still means business. With camera person Surinder Kumar, in New Delhi, Ragini Verma, Bloomberg UTV.
Corporate India and policymakers are eagerly awaiting Budget 2012 to see how the finance minister will tackle concerns on the fiscal deficit. But for millions of taxpayers in the country, it's the impact on their investments and their taxes that takes precedence. So will Pranab Da be able to cheer the taxpayers as he walks the fiscal tightrope? Priyal Gulyani finds out.
Come March 16 budget day, and taxpayers across the nation will be looking towards Pranab Mukherjee and his budget briefcase, hoping that fiscal goodies would be on the cards. The Aam Aadmi has been the worst affected by rising costs, inflation eating into investments and stagnant or marginal increase in salaries, and he's seeking some relief from the finance minister. The direct tax code held out, among other things, the promise of moderating the tax burden of this class of people. This salaried class, easily the most squeezed by the government for tax revenues. The code was expected to be implemented by April 2012, but it's highly unlikely that it will kick in before April 2013. But some have different view.
I expect the DTC to be in place. I know it'll happen.
But some experts are of a different opinion, and they say there could still be some cheer for common taxpayers in the forthcoming budget. They are of the opinion that some aspects of DTC will find its way in the coming budget, which could boost incomes somewhat and shield the man on the street from high inflation.
DTC was to come into operation from 1st April 2012. It appears it's not coming. Okay, no problem. But what taxpayers want is at least some of the beneficial parts of DTC, which will cause no tension to the government. They should be implemented right from 1st April 2012. There's no problem to the government, like raising of the basic exemption limit.
The Parliamentary Standing Committee on Finance has proposed that the threshold limit for exemption from income tax be raised from the current 1,80,000 rupees to 3 lakh rupees. If the Finance Ministry agrees, this could perhaps find its way through this budget itself. A back-of-the-envelope calculation suggests that if it happens, taxpayers will save around 11,000 to 12,000 rupees in a year. Apart from the exemption limit, there is a push to enhance investment limit of 1 lakh rupees, which is currently available as a benefit to taxpayers by the way of deduction from one's taxable income. The Standing Committee has proposed an increase of this tax benefit window to 2.5 lakh rupees. On the other hand, the government is under pressure to enhance a very common tax benefit window for home buyers who finance their home purchases through bank loans.
If we have a peep into the rising cost of the houses in last 1 decade, then the expectation is minimum 3 lakhs rupees, yes 3 lakhs, should be the ideal limit for grant of deduction for interest on housing loan. But frankly speaking, I don't think 3 lakhs will come this time. At least if something comes up in 80C, taxpayers should be happy.
One of the major concerns that experts have is with regard to the exclusion of equity-linked savings schemes or ELSS from Section 80C in DTC. ELSS is the only pure equity instrument that came with tax benefits, and financial advisors hope that the Finance Minister provides some impetus to saving instruments such as ELSS and ULIPs to enhance participation of retail investors in the equity markets.
Last year we saw a lot of unproductive investment from the retail households with money moving to gold. And that is not really productive for the economy. We want to see money being available for industry, for infrastructure sector, and that will come through investment in insurance plans, ULIPs, ELSS. So government needs to think of ways of encouraging retail investors to put their money in these instruments over gold.
The taxpayer has a long wish list, but Pranab Da has limited fiscal bandwidth within which he has to balance his budget. On one hand, the beleaguered government, tainted with corruption charges and accused of policy paralysis, is under pressure to bring some cheer to taxpayers. On the other hand, fiscal profligacy is something that Pranab Da cannot afford at this point in time. So will Mr. Finance Minister be able to balance the budget? We will find that answer on March 16th. Priyal Gulyani Bhattacharya, Bloomberg UTV, New Delhi.
Up next, we find out what the budget will mean for the auto sector. The real estate sector is facing a severe cash crunch, resulting in project delays across the country. What does the sector want from the upcoming budget? Ruth Sadana gets us those details.
Developers and analysts have one major expectation from Budget 2012, industry status for the sector.
The objective, of course, is if you give an industry status to real estate, then what happens is that the risk weightage which the banks provide on this sector would reduce. More funds coming into the sector.
Industry status will allow real estate players access debt at competitive rates and lower collateral. And the players also want tax breaks. Currently, nearly 35% of the sale of a home consists of taxes, including VAT, excise, service tax and stamp duty.
And that has worked very well in the context of tier 1 cities. And that same model, if done well, and if this tax holiday can be extended, then effectively that same model will attract a lot of companies to go to tier 2 cities as well.
Apart from this, affordable housing too needs some work, and the players hope the government will help.
There's a need to promote an affordable housing fund wherein a part of the corpus can be provided by the government, partly, which can be, raised through the bond market from retail investors.
Finally, one of the biggest problems for the sector is approvals, and developers hope a single window clearance will be set in place to ensure that prices stay under control. Ruth Saldana, Bloomberg UTV, Mumbai.
When Pranab Mukherjee rises to present Budget 2012, auto companies will be among those watching him anxiously. A proposed tax on diesel vehicles could increase prices by 22%, worrying most manufacturers and forcing them to defer ambitious investments in diesel engine factories. Kartika Trehan files this report.
As the government gets ready with Budget 2012-13, there has been speculation that the higher taxes could be imposed on diesel passenger vehicles as the subsidized fuel has been diverted for personal use by the effluent buyers. The automobile industry is of the view that such a move would stigmatize diesel technology, which will be very unfair to the sector.
They're talking about the separately cars being taxed which are using diesel as a fuel, which is, in my opinion, a retrograde step. Diesel all over the world is considered more fuel efficient, it is less polluting, and therefore whether it's Europe or US, we are having more and more diesel vehicles getting sold. Diesel technology has come a long way.
In an earlier recommendation by Kirit Parekh committee, it has been suggested that an additional excise duty of 80,000 rupees can be imposed on diesel cars to discourage diesel being diverted for the personal auto segment. Experts believe that the proposed tax on diesel vehicles could increase prices by 22%. The demand for diesel passenger cars has increased over the years due to the big price difference between diesel and petrol. The demand is so skewed that in some cases it is above 85% of the total demand of the vehicle sold. Companies like Tata Motors and Mahindra sell more units thanks to the demand for diesel vehicles. Even Maruti, which was known for petrol cars, is seeing demand in excess of 80% for diesel variants when the option is available to the consumers.
With the budget hitting some additional taxes, obviously there will be most likely a slowdown in the market demand. So that will be definitely not in favor for some growth in the future. So let us see. Very difficult to predict, but I have a lot of faith into the government.
I would say like the small car market, where you see that diesel engines slightly more expensive than petrol engines, but not much more. If there is an impact that the prices go up, I would see that we see probably a shift back towards very economical petrol cars. But I think luxury is fairly insensitive to that approach, and I think we will not see a hike in the diesel price on the petrol pump much, because that's the public transport sector you're touching, and I think that is a very sensitive issue.
Diesel is the new petrol, and manufacturers are getting on to the new oil-burning bandwagon. Budget 2012, however, may play a spoil sport, and car manufacturers may have to wait to take the final call on their investment plans in diesel engine factories. Kartika Trehan, Bloomberg UTV, Mumbai.
That's all from us on this special edition of Countdown to Budget. Thanks for watching.